You want to go skydiving, but you know it's not without risks, so you decide to buy some life insurance. You can buy $1,000 of coverage for only $5, but you really want to buy $10,000 of coverage, which is going to cost you $50. What's the expected value of buying the life insurance? We have to know the probability of unfortunately dying while skydiving, which is pretty small, only 7/10,000ths of a %, but there is still a chance that the unfortunate could happen. We'll make a table to determine the expected value. First, we need to think of the possible outcomes of skydiving, which are either you live or you die. For each outcome, we need a probability. We've been given the probability for dying, and we'll write that % as a decimal. Now, since you either live or die, the probability of living is 1 minus the probability of dying, which is 0.999993. Each of the outcomes has a value. Let's start with the value for dying. Now, obviously, if you're the person who died, there isn't much value to you, but there is a value to the beneficiaries of your policy of $10,000. However, it did cost you $50 to buy that policy, so the actual value to them is $9,950. Your beneficiaries don't receive any money if you live, but it did cost you $50 to buy the policy, so the value of living is -50. Now, to find expected value, we need to take each probability times the value of that probability. So we'll do that for living, and we'll do that for dying. Now, to find expected value, we simply add those two numbers together, and we get an expected value of -$49.93. That means that on average, every person that buys $10,000 worth of life insurance before they jump out of a plane will lose $49.93. And on average, the insurance company will gain $49.93 for every person that buys $10,000 worth of life insurance and then jumps out of the plane.